Welcome back to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm really pleased to tell you my guest for this final segment of today's show is John Rubino. Those of you who may not be familiar with John can read his bio on this website that is on the Voice America website, my page, the Turning Hard Times into Good Times page at the Voice America Business Channel. Most importantly, though, I would urge you to go to John's website to learn more about him and to gain access to his very valuable market insights. John sends out his reports to people, so I'm quite sure you can put your name on the list, and John will be happy to send out his missives, which I find very valuable and very helpful, and that's why I have John with me today. I should tell you that you should go to dollarcollapse.com. Dollarcollapse.com is a place to go to pick up and to learn more about John Rubino. Welcome, John. It's good to have you with me again.
Hi, Jay. Good to be back.
Always good to talk to you. You know, Dr. Robert McHugh, he's a technical analyst who we have on this show occasionally. He believes we're approaching what he calls the most cataclysmic stock market decline in our nation's history. That sounds like quite an ordeal ahead of us if he's right. I mean, 1929, we don't think we have anything close to that. We would like to think not. He has his own theories about why we're approaching a doomsday scenario, but his approach is he's really a technical analyst, and he certainly does pay attention to fundamentals, but he uses his technical analyses, Elliott wave, and a host of other things that he uses. He notes that there's a huge megaphone formation that has been formed over the past decade for the Dow Jones and the S&P 500, and then he notes that within that is a smaller megaphone formation. And he refers to those formations also as the jaws of death, in part because every major stock market crash that we've had since 1929 has been preceded by these megaphone formations. But not only that, they have brought with them, unfortunately, very significant warfare and wars that have gone along with it, hence the name the jaws of death. Now, I mention McHugh because it is connected, I think, in some ways, at least in my mind, with your latest article written at the dollarcollapse.com website titled "We're All Hedge Funds Now, Part 2, Tech Startups and Nigerian Bonds." That's the title of the missive that I found very, very interesting, John. Indeed, the global economy and world monetary system is extremely messed up now, thanks, I would argue, to decades of Keynesian monetary policies that has led us to the sort of ridiculous place where people are actually paying banks now for the privilege of giving them their money, which the banks turn around then and use to make more money for themselves. So, John, zero interest rate policies, as your article points out, is leading the world to an ever-increasing risky environment, and I firmly believe they are leading us into the jaws of death that Dr. Robert McHugh talks about. Whether it's going to be as cataclysmic as he claims, I don't know, but something sure looks like it has to give. Can you explain to our listeners, in the first place, why do we have negative interest rates, and why in the world should we pay banks to take our money, which they can then use to make more money with?
Well, the very concise version of the story is that we've borrowed way too much money. And debt works the same way for a country as it does for a family. That is, if you borrow too much, the money that you would otherwise have spent on productive stuff, like factories and roads and bridges and education, have to go to interest payments. And that slows down the economy, makes life harder for voters, makes it way harder to get reelected for sitting politicians. And so nobody likes this, and everybody takes steps to combat it. And what governments have done repeatedly over the last 40 years is they meet a slowdown with easier money. That is, they run big government deficits and they cut interest rates. And in that way, hope to induce the private sector to borrow more money and get the economy moving again. And it's always, quote unquote, worked, but always at a cost, which is more and more debt in each cycle, and heavier and heavier interest burden, and more of a challenge to get things going again. So we reached the point now where they've pushed interest rates down to zero. They in theory couldn't go any further, but what the heck, they just kept on going. And now we've got negative interest rates in a lot of different places. There are about $2 trillion worth of bonds trading in Europe right now with negative yields. That is, you have to pay them money to own their bonds.
Wow.
And a lot of different countries have bank accounts now that, if you want to deposit some money for a savings account or buy a CD or whatever, you get either next to nothing or less than nothing. You have to pay them to put the money in the bank. Now, within the economics community, there used to be a widely held belief that zero was as low as interest rates could go, because at that point it made no sense for people who have cash to put that cash anywhere. Just keep it at home where it doesn't cost you anything, rather than put it in a bank where it actually costs you money.
Yeah.
But it hasn't turned out to be true. People are willing to buy government bonds with negative yields in some cases. They're willing to put money in the bank where the CD or the bank account actually charges you money instead of pays you money. And so now economists are scrambling to figure out what that means theoretically and practically. How low can interest rates go if negative interest rates are possible? But one thing, while this is going on, one thing that we're seeing is a lot of behavior change out there, because there are a lot of institutions and individuals who need positive yields in order to function. For instance, a retiree who retired on the expectation of 6% interest on bank CDs in order to live and not have to eat into principal, now finds himself losing a percentage point or so each year instead of making 6% and having to eat into principal or go back and get a job. In other words, stop being a retiree. And pension funds and insurance companies and money market funds are all kind of in the same boat. They require positive returns in order to meet the obligations they've taken on. And yet the fixed income part of their portfolios don't really give them returns that are commensurate with their promises anymore. So maybe they earn 1 or 2% blended on their bond portfolio. Well, they need 6 or 8%.
Right.
And so what we're seeing out there, and I assume this is government policy, they're wanting the private sector to do this. We're seeing all of these guys move further and further out on the risk spectrum. In other words, if a government bond doesn't pay you enough, well, let's buy junk bonds then, or equities, or other exotic things. And a lot of the news lately is about stuff like that. For instance, Norway's sovereign wealth fund is now buying Nigerian government bonds and the bonds of Petroleo Brasileiro, which is the big Brazilian oil company that is deeply into a bribery scandal and is looking like it's getting ready to collapse. Well, they're buying those bonds because they need yield. And high-grade bonds don't give them any kind of a yield anymore. And Europe's biggest insurance company is selling its German bonds and buying mortgage-backed bonds. J.P. Morgan Chase's mutual funds are putting their clients into speculative-grade corporate bonds and lots of other things like tech companies that aren't yet public. This is venture capital stuff here. And we've got mutual funds that are in people's 401k plans buying stuff like this now.
Yeah.
And buying it at valuations that are, tech stock bubble levels, something you would have seen in 1999. And people who are saving for retirement and trying to do so in a low-risk way are now owning these things. So you're seeing the whole economy move way out onto a part of the risk spectrum that used to be occupied by hedge funds, which are unregulated investment companies that can take any kind of risks they want to and only take money from really sophisticated investors. Well, we've got everybody, unsophisticated, dumb money now out there on that part of the risk spectrum, and that can only lead to horrendous problems when we have the next market correction, right? Because stocks and bonds, or stocks and junk bonds, they go up and then they go back down, and that's how those markets work. So you can have a 20 or 30% loss on an equity portfolio in just the normal course of life. Well, there's lots of people and lots of institutions that can't handle a 20 or 30% loss. But now we've got them out there, and in a lot of cases they don't really understand what it is they're doing and what their risks are, because this is new territory for them. So that's the kind of world we've created with negative interest rates, and it can't possibly end well.
No, I can't see how it can. And of course, the hedge funds were and are still, I guess, reserved for wealthy people. So if they lose 20 or 30%, it doesn't put them in the poorhouse. It doesn't put them on the street. But now we're talking about the whole spectrum of people in one way or another, the whole society almost that is living way out there on that risk curve. And John, why do you think the risk? I mean, there was a time when people wouldn't do that. They certainly wouldn't. They wouldn't. You mentioned these. They're taking these extremely risky. The reason they have the high yields, and we've seen it, of course, with some of the sovereign risk debt too, like Greece and other places. People go out there and buy those things to get the yield, knowing full well that they're very, very risky. Well, it must mean that people think that the government has an ultimate safety net to put under those things. So if the pension funds go down, they can count on the goodwill of Uncle Sam or the Federal Reserve to print more money out of nothing and bail them out again. Is that what's underlying this willingness to take on that kind of risk?
Well, yes. Well, it's two things. One is they don't really understand the risks because they've seen these things do well over the last few years, and most investors who typically buy low risk stuff aren't paying attention to the nature of junk bonds or to private equity tech companies and stuff like that. They just don't know what they are. They know what they've gone up lately, and so they assume that must mean that the experts in this market think they're solid investments. And so they're getting into it without really knowing what the risks are. And as you said, there's an implicit government guarantee now in these markets because we've got governments all around the world intervening in equities and bailing out big banks. The big banks came through the last financial crisis unscathed.
Right.
And the big bankers got record bonuses in 2009.
Instead of spending time in jail,
by the government, and their equities have come back, and so the stock market is up, and bonds have gone up, and it's all because governments intervening in the market really aggressively are pushing these instruments up. So everybody assumes that can continue forever. And that's the assumption that's going to be tested pretty soon because it's highly likely that this can't continue forever. When you got stocks already at priced for perfection levels, they're at record levels around the world right now. We've got bonds at record levels. Interest rates are at record low levels. So these two asset classes are at the tail end of really long, dramatic bull markets where historically they've had big corrections because nothing goes in a straight line forever because you get these huge imbalances that have to be worked out at some point. So what's happening now is the imbalances are bigger than ever because we assume that the governments of the world won't tolerate a correction anymore. So if you're a rational trader, let's say, not an investor but a trader, and you see something like that, well then you load up, you follow the government's lead and buy everything without regard to price because you assume that these incredibly deep pocket institutions, the central banks of the world that can create as much new currency as they want to, are now at your back. The Japanese central bank is aggressively buying equities all around the world right now. And the U.S. is probably doing it. They're not announcing that they're doing it the way Japan is, but they're probably in the equity markets too. Mm-hmm. And if they can print as much money as they want to, and their goal is to keep the stock markets up, then what's the problem?
What is the problem, John? I mean, that is true. I mean, I have to think that if the pension funds...
And, the flaw in that is that the very fact that everybody assumes that there's no risk creates huge amounts of risk because they all behave in ways that increase the likelihood that something bad is going to happen. Like what we just talked about. When you've got regular mutual funds loading up on private equity tech companies, and you've got pension funds loading up on hedge funds, which are aggressive companies that can that take all kinds of risks, and you've got sovereign wealth funds buying really, really sketchy paper like Nigerian government bonds, then you're creating the conditions in which something out there is likely to blow up, and it's likely to spread when it happens because everybody is leveraged to the hilt. Everybody is priced for perfection. And so nobody can tolerate a serious correction anymore. If you've got high-grade government bonds and the world has a recession, you're basically okay. The bonds might fluctuate a little bit. But if you've got Nigerian government bonds or you've got tech companies that are priced at 100 times revenue, you've got air pockets under your assets. And if you've borrowed money in order to buy those things, then you can be bankrupted instantly by a garden variety 20% stock market correction, and we're putting more and more people in that category.
Yeah. So, John, I have to say, the pension funds then, of course, have to be in the forefront of the Federal Reserve's mind. And every time that stock market, the Fed would like to increase rates, would like to normalize rates, as they say. But every time there's even a whiff of that possibility, the stock market throws a temper tantrum, and the Fed comes back and says, oh, we didn't really mean it. We'll be very careful. We'll be patient. And the market heads off into new high territories again. So it seems to me that the Federal Reserve is held hostage now by this pathological market condition that they've created, essentially. They and the governments have created by this massive amount of debt money printing, right?
Well, they absolutely have a tiger by the tail right now because they're not idiots. They see the imbalances building up out there. They see all the stuff you and I are talking about. And the part of their brain that functions as a prudent banker, if you're a Federal Reserve governor, you've got one aspect of your personality that is a banker aspect. And you would say, well, it's time to ease back and try to stop these incipient bubbles from blowing up and stop these imbalances from building up before they become debilitating. Well, you can't do that anymore because the minute you try, like you said, the markets throw a fit because everything is priced for perfection. Everything depends on a torrent of new money coming from the government. And as soon as that spigot is turned off, everything's going to fall apart. Everybody knows it. The guys running derivatives books and the hedge funds out there, leveraging themselves to the hilt in order to buy emerging market equities. Everybody knows it. And
so those guys are going to head for the hills
of the Fed turning off the spigot. And the minute it looks like that's actually going to happen, everything starts to fall apart. So the Fed can't do it. They have to continue with easy money forever now.
Okay, John, we only have a couple of minutes left here yet, but so it seems to me that, these smart hedge fund guys, as soon as they get a whiff of that, they head for the hills. I mean, they're out of there. They're selling as hard as they can. And in order to stop that, then the Fed has to come back in and pump huge amounts of money in and use some kinder words to convince the people that they're not really serious about raising rates and embarking on an honest monetary system, policy of any kind, huh? Yes. It has to continue. Yeah.
So that's what we're seeing. 2 weeks ago, the Fed was going to raise interest rates in June. And now they say, oh, well, we'll be more patient. We'll wait longer. Maybe it'll be September. And now you've got Fed talking heads coming out and floating December as the start date for an interest rate.
John, unfortunately...
Well, they're never going to be able to do it.
John, unfortunately, we're out of time here. We've only got a minute left. What do you tell our listeners they should be doing now, given this scenario? I mean, should they just be buying stocks like there's no tomorrow?
Well, absolutely not. They shouldn't be buying stocks, although that risks missing the last up leg in this crazy bubble that's going on. But I think you should be preparing for some kind of trouble just because we've created the conditions in which trouble is becoming more and more likely because of all the stuff that you and I just talked about, all the decisions people are making that inevitably lead to trouble. And so something bad has to happen. Some kind of resolution has to happen. So we should be scaling back our financial exposure. Paying off debt, raising cash, buying things like precious metals and possibly well-chosen functional assets like real estate or farmland or something like that. Things that have value and can't be created in infinite quantities by governments on printing presses.
Very good, John.
Hopefully we can weather the storm, because this is going to be a really hard time for a lot of people. And
I'm
we
afraid
want to be as self-sufficient as possible when it really hits the fan.